Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Dan Brisse. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's program is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Dan Brisse. Dan is the co-founder and principal at Granite Towers Equity Group, where he oversees the operations, acquisitions, investor relations, and asset management. Dan is a resident of Southern Washington. Dan is also a former professional athlete. As a professional snowboarder for over 13 years, Dan took home multiple X Games gold medals and was known as one of the top urban snowboarders in the world. Dan's drive for excellence and success transpires into Granite Towers real estate portfolio. Dan is also the co-host of the podcast Keeping It Real Estate and the co-author of 4 Steps to Successful Passive Investing. And in just a minute, we're going to speak with Dan about the multifamily marketplace for 2023. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Dan Brisse. Welcome to CRE PN Radio.
Hey, Darren, thanks for having me. I'm excited to be here.
Well, I'm really looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, you bet. I grew up in central Minnesota with this childhood dream of trying to become a professional snowboarder. And, at that age, I was 10, 11 years old, 12 years old. I went and told everybody about how I was going to be this pro snowboarder. And most everybody told me to get real. And, it was like, you are in Minnesota. There's no mountains here, Dan, or maybe you should have a backup plan for that. And, long story short, my parents believed in me, and I told my parents, and my mom and my dad told me go for it. My parents were the biggest asset I've ever had in my life growing up. I mean, they just said, we didn't do what we love. Make sure you do what you love as you grow up. And I never forgot that. So with their, support, I head down and started snowboarding and just did it because I loved it. I didn't, first 2, 3, 4 years of snowboarding, I didn't want to be a pro snowboarder. I just loved doing it. But by the time of 15, 16, 17 years old hit, it was very clear that they were pro athletes. They were these guys who traveled around the world, got paid to snowboard very well, and had a career out of it. So that was kind of the background there. And as 18 years old, I moved out of Minnesota. I transplanted to Salt Lake City. I lived in Salt Lake City for 10 years. I never had any financial help from my parents. I worked the most odd jobs you can imagine as a alley coordinator at Red Lobster. I worked at Blockbuster checking people's out for movies. I was a busser at TGI Fridays. And after being in Salt Lake City for 4 years, grinding, working my tail off, snowboarding every day, I went to the Aspen Open in Aspen, Colorado. And my buddy actually paid for me to get in the contest, and he drove me there because I was still living paycheck to paycheck. And I entered the contest, got through finals. I had to get through 250 riders to be the top 10 to get to finals. Finals day came, I won the contest, and my career took off, and I had a really great, successful run as a professional snowboarder, and I've now since transitioned into real estate investing. So that's I'll let you go from there, Darren.
Well, I'm just going to encourage any of our listeners, if they want to see some of the rides that you took, it's pretty easy. If you Google or search on YouTube, Dan Brisse snowboard, you'll be entertained. It was pretty amazing stuff that you did there. Extreme. I mean, extreme. Amazing.
That is the right word. Extreme.
Yeah. But well, awesome. Like I said, I'm really looking forward to our conversation. So tell me a little bit about the transfer from your snowboarding days into real estate? Because it's not exactly like they're connected, other than the fact that you were snowboarding on real estate there.
Yeah, good way to put that. Yeah, really what happened is as I got into my career and I started to get to know a bunch of the other pro snowboarders in the industry who were older than me, I saw some of their careers end, and it was brutal. It scared me. They ended up coming into this career where you're this huge known athlete getting paid very well, traveling the world. Everyone knows you. You go up to these events, everyone wants your autograph, and then the career ends and you're a nobody. Or at least that's how you feel. You're still somebody, but your identity of who you were your whole life is gone. You maybe didn't manage your money well, like most folks that they start making money as athletes, they just don't know what to do with it. I hear so many people saying the money ruined me. It wasn't the money. You just didn't know what to do with the money. You give someone $1 million and they're broke 2 years later. You give someone $1 million and they're worth 4 million, 2 years later. It's about what you do with it. So really what happened was I just kind of got scared and started reading books on what separates folks and what's the difference between people who do well and take their money and multiply it and other folks that lose it all. So I read a bunch of books, and I started investing in real estate after I figured out I wanted passive income. That was my main goal. How can I find a way to create residual money coming in, whether I work or don't work? And then how can I get a tax savings? How can I get a tax break based on my income? And so I hired a CPA out of Arizona after reading a bunch of books, and we set up a business plan with them, including my wife, to help with the real estate investing. And we were off to the races buying smaller stuff. I bought a duplex in 2012. I bought a 9-unit deal the year later, and then I bought a 24-unit deal, all on my own, all my self-education. Didn't have a mentor yet, but was just reading books and trying to find a way to invest the cash I was making.
Cool. So seeking some sort of a plan B, passive income, you're drawn to real estate. And if I understand correctly, now with Granite, you guys are doing syndication. Is that correct?
Yeah, that's correct. After buying our first few deals on my own, my business partner now, Mike Roeder, one of my best friends I grew up with, he's actually in high net worth insurance sales. He was buying a ton of single family homes in central Minnesota. And I just said, hey, let's buy a deal together. So he, myself, and one other guy that I went to high school with bought a 28-unit deal together. And then Mike and I went on to hire a personal mentor, somebody who had been doing this for 24 years, had several thousand doors, and had the results we were looking to, move to for Granite Towers. So we started the company, and since then we've been buying, 150 to 400 unit deals with private investors, all value add apartments.
Got it. So let's see, you said around 2012, you bought your first duplex. When about did you start syndicating?
The first deal we syndicated was in 2017 or 2018. So there was a period of time there where there's a steep learning curve in real estate. It takes time. Everything takes time. So it was 2017, 2018. We didn't raise money until we had or really raise money from several investors until we had more training.
Got it. So, and now how many doors do you guys have under?
Yeah, we're right around 2,400 units or so, just around 300 million of assets under management that we're overseeing as our team at Granite Towers, takes the property from where it is to its new level through the business plan operation.
Got it. So is it primarily a value add strategy that you guys use?
Yeah, it's exactly like that. Every property is pretty dang similar. It's a rinse and repeat model. We don't buy office and storage and all the other stuff. We focus on B and C, and we have one A-class deal, multifamily in Dallas, Fort Worth, and Nashville, Tennessee. And that's really all we look at.
Gotcha. Yep. So excuse me, in the run up here till, we're talking now, it's January of 2023.
Mm-hmm.
The last, 5 or 6 years, or even before that, I want to say back when I first started this podcast in I think it was 2015. I remember talking to people going like, oh my God, it's, we're running extra long and extra innings. It's at least the normal cycle of things was running kind of long from when the crash had happened. They were expecting a crash to occur then. Clearly, it didn't happen. We had multiple things that kind of interrupted the normal cycles, including COVID. Um, your build up to the 2,400 doors. How many times have you gone full cycle? How many deals have you guys sold and
Yeah. Yeah, we've gone full cycle on 6 deals, 4 that have been syndicated. The 2 that I bought before I've sold off on my own. So that's where we're at currently.
okay? And in the syndication model, raising capital, um, how tell me a little bit about that as far as your experience with the initial efforts to raise capital versus where you are now.
Um, you know, the market is changing quickly right now. Obviously, everybody knows, being we're in is January 2023. When we first tried to raise money on our first deal, we raised $575,000 on a 45 unit deal located in River Falls, Wisconsin. And because of our database at the time and the work we had done and the folks we had already spoken to about what we were doing, it was relatively quick. It was probably 3, 4, 5 days. And we had maybe like 10 or 15 investors who threw in 50 grand. So it was always very easy, knock on wood. It's always been very easy to raise money. I think that you've got some positives and some negatives. The positives are that, cash is looked at more, I think, as trash at times. You hear guys like Ray Dalio saying cash is trash on NBC News. I mean, that catches some attention. What does that mean? Obviously, right now, cash feels like king. So are you still thinking cash is trash? I don't think it is. I never thought it was. But I think you have more folks that are thinking, hey, I can't let the dollar sit in the bank. I need to find a place to create some residual income, find a tax savings. Can I be a part of the inflation through, the destruction of the dollar? So I think there's going to be challenges for different groups. It really depends on, what do you know and what kind of reputation do you have in the real estate business?
Got it. So you mentioned like the first deal, it took you only like a couple of days to raise the money you needed. Are you guys actively looking for properties now? Do you have any um, under contract, or where are you at in your acquisition phase?
Yep, we're always looking. We every single deal that comes out in Dallas and Nashville, we're underwriting and trying to see how close we can get to the whisper price or their offer price. Right now, we don't have anything under contract. We have submitted a few offers, and it's just there's a gap right now. And realistically, there's a gap. I mean, if I'm selling, which we're selling one deal that went under contract in June, and the gentleman is still trying to get it closed, and he's got $860,000 of non-refundable money that he's already released to us that we have in our bank account. And, for us, we're still of the opinion that you put the deal under contract in June at that price, that's the valuation. He's of the opinion that interest rates have moved and now, the values come down. And I understand what he's saying, but our NOI has also massively increased. And, most of the time you don't close a deal over 6 months, you close it in 60 to 75 days, at least we do. So I do sympathize and understand the market's change, but this is a very dangerous time to be buying if you don't know what you're doing. Very, very dangerous, and it's not the right time to be coming into a market. If you're a newbie investor, wait for this to blow over, wait for interest rates to bottom out, wait for something to become more stable than trying to get into a market right now. So there's the gap between the buyers and sellers. Sellers want prices from June. Buyers are saying your price is crazy, we're not paying that. So we're at more of a standstill, I think.
And that kind of sums up kind of what my sense of things have been, but yet I still hear about, deals being done. I'm kind of curious, have you, in the deals you've underwritten, has there been any change in your strategy as far as maybe some of the, the points you were looking to historically for whether it be value add or has it been more of a financing, Rubik's Cube on how to solve the financing?
Yeah, our biggest change definitely is what we're using for debt, and how we're going about that. And that affects what you can pay for these deals. When you're in a very volatile market like you are, how do you go put bridge debt on? And bridge debt, where the variable rate, you might get way more loan dollars, but just because you're getting more loan dollars and the returns look better on paper does not mean, in my opinion, in our philosophy at Granite Towers, that that's the way you go. So our biggest thing is just low leverage fixed debt. And if you can't make the deal work with low leverage fixed debt in a market we're familiar with, then we're going to wait a little bit. We're going to stack cash and see how things play out. We've bought a lot of deals over the last 4 or 5 years, and if we have to pause for 6 or 12 months to see what comes of this, we're going to pause.
Got it. And historically, your acquisitions, have you raised the capital for the value add capital improvements, or have you built that into your loan, or have you done bridge financing, or how have you
Yep.
handled the capital improvement budget?
Great question. We've done it all. We've done it where it's financed through Fannie Mae, and we've done bridge. And we've done it where we raise the capital and just have it liquid in our bank account. Right now, the last 3 deals we've bought has been Freddie Mac fixed debt, and we raised the CapEx and it's liquid, and it gives us more flexibility. Prior to that, we've done some bridge debt that we've put rate cap insurance policies on, where as rates rise, which they have, now you have your rate cap insurance paying you to offset your cost in debt. Still very uncomfortable. Something that, as we go through this cycle, probably will be very hesitant with bridge debt moving forward. Doesn't mean you still can't do well with the deal. I think there's still an opportunity as long as you manage very well, and you can make it through this elevated interest rate period. How low do they come down? When do they come down? That's the unknown factor. So you need cash reserves to get through that stuff. And then the other one, Fannie Mae debt with your CapEx finance, we've done that as well. It's just a little bit more tedious and much more of a headache to get those loan dollars when you do want to use them. They're very, very critical on seeing exactly what you did with the money. Was the work done perfectly? And then you get your money released. So it just depends on the deal. It depends on your business plan.
Yeah, on those the Fannie CapEx dollars, is that kind of like a construction loan where you have to submit all the work that was done and they inspect, or?
Yeah, that's exactly how it goes.
Okay.
It's just part of the loan. I don't think they consider it a construction loan, like a second loan. It's just part of the loan that's you can tap into when you're ready. It's available for you.
Right, but those CapEx dollars are like in escrow and you've got to submit
Yep,
proof. Okay,
that's
gotcha.
100% correct.
Gotcha. So as far as the kind of the market change, I guess what I'm trying to think is on your hold times. I'm assuming that up until now, there've been multiple people I've talked to they bought the deal in January, and maybe January the following year they've got an offer to sell at a multiple that they hadn't anticipated for a couple of years. I'm assuming, or let me ask it this way: are you seeing your hold times extend based on just the market and kind of the buyer seller gap? Do you anticipate holding your deals longer than maybe you might have a couple of years ago?
Yeah, it 100% will be dependent on what happens with interest rates in this recession and how deep we go and how long the Fed holds rates where they need to hold them. I don't know right now. That's the part where if you want certainty of weathering a storm, you want to have fixed debt for a long period of time, because you don't control when Jerome Powell is going to bring rates back down, or the Federal Reserve decides that it's, we're far enough. We need to help the market come back to life. So, going back to the biggest change we've made is just low leverage, fixed debt. You can weather storms. Yeah, you're going to have a prepayment penalty if you want to exit early, and it's probably going to be a little bit painful, but which would you rather go back to your investors and say, hey, we're going to exit. We do have a prepayment penalty. Your return, instead of being 110, is going to be, 97%. Or, you know what, our bridge debt is needing more capital, put in 50 grand right now, or we're going to lose the deal. I mean, what would you rather be in? As a syndicator, I'd rather be in the first, position, and always that position. I want boredom. I want to be bored. I don't want to be gripped one bit when I'm investing in real estate. You shouldn't be. If you do it right, it should be somewhat boring. And if it's exciting, great. You're just going to sell for more because the market's good.
Yeah, no, exciting is good when it's the right kind of exciting, not the, oh my God,
Yeah.
uh,
Yeah.
the exciting there.
Yeah.
What about rate increases, not rate increases, but rent increases? In the last few years, there's been quite a run up based on supply and demand, um, and inflation, et cetera, and all that. In the market you're in Texas and Tennessee, are you seeing or have you seen substantial rent increases? And also looking forward, based on kind of the economic conditions we've discussed, do you have any kind of expectations for rent increases, or what are your expectations for rent increases?
Yeah. Thus far with our DFW deals and our Nashville deals, we're still seeing very large rental increases in somewhere between, that 12 to 30%, which is not normal, based off of history. What we think is coming with the oversupply of A class is definitely going to be less. How much less? Again, unknown. Do we have negative rent? I don't know. As far as what we're underwriting, we're taking a look at CoStar, what they're projecting. We're taking a look at our 1 mile median income. We're making sure we have a B or C class deal. A class, I think, will probably get wrecked a lot harder than B or C class. And, based off of what we can see with our primary data of what the other competitors are doing, and we take a look at CoStar and compare it, we'll make a rent projection based off of that data of what's coming over the next 5 years. This is part of real estate, though, that's always been a challenge. What do you think your exit cap rate's going to be? What are rents going to do? Where are interest rates going to be? There's no way of knowing that information other than, and I think you can read a lot on cycles. That's one thing I think is worth putting more time and effort into, is studying real estate market cycles and trying to better understand, if you're going into a downward cycle, what have the past cycles look like, and should you be using some numbers that are closer to what they were modeling in 2008-9? Maybe that's your best kind of, projection of the future as of right now here in 2023.
Yeah, no doubt. The funny thing to me is, and this is just my, brief, experience in investing and just kind of observing the market cycles and that, but it feels like a lot of times what happened before corrections have been made, like take for instance the Great Recession. There were measures put in place by Congress and other kind of real estate lender fixes that were put into place. And I have this weird sense that a lot of times people, when they look to the future, because they see certain signs, they anticipate it's going to happen just like it did last time. Mm-hmm. But what I've seen is that, wherever the problem came from last time, those holes have been plugged. Mm-hmm. And so now it's not leaking over here, but it's, over there or up there or down there kind of thing. There's a different cause, but it doesn't mean that it won't be the same effect, but it's just about where it's coming from. And I think also one of the challenges that I think we have this time is with all of the cash that was pumped into the marketplace. Mm-hmm. There's still, and I haven't looked at anything recently, but it seems like I read somewhere that, the amount of cash, whether it be savings or just, just cash that people are holding as cash, as opposed, liquid, is significantly greater than what it had been historically. And I should probably check and have a resource, to cite, but there's it's been more like a sense of like kind of hanging on, like, we might need this.
Yeah.
kind of cash. And
Yeah.
so,
Yeah, I don't know if you're familiar with Ken McElroy. He shared a pretty
oh yeah,
interesting chart on that as far as the amount of cash in people's bank accounts. And it was very, very high during COVID, and very quickly it's been coming down to some of the lower levels we've seen in recent history over the last 3-4 months. So the direction we're heading is definitely towards pain. The part that's interesting to me is how much the Federal Reserve controls the market with interest rates. I think a flick of the pen and they bring rates down 2% overnight, and all of a sudden everyone's refinancing deals. People are able to now sell deals. People are back to buying deals. People are back to building. It's just unbelievable. And the other piece I think that's unique now compared to the Great Recession is the amount of unrest between the folks in their country. I'm concerned as we go later into this debt cycle, and Ray Dalio talks about this in The Changing World Order. It's a great book. If you haven't read it, take a look at Changing World Order by Ray Dalio. Just talks about, as you get late into a debt cycle like we are, that the amount of synergy and people working together goes down, and you have more fighting amongst political parties. And we're seeing that. I mean, I can tell you right now firsthand, Portland is a different city now than it was 2 years ago. And I don't know why there isn't more action being taken to stop what's happening, because it seems very clear of what we need to do, but it seems like it's being allowed, and it's trending down very quickly. So that's the other piece is how much do people fight versus do they get along?
excuse me. Yeah, no doubt the work together versus the the friction in all phases, but more dramatically so in the political space. And I think there's all sorts of things you can point to that probably exacerbate that, but it's just really a sad state of affairs when you see the only thing that's being publicized is about how the other guy is all wrong, as opposed to going behind closed doors and finding out where the common ground is and trying to come out with a solution. But yeah, I mean, Portland right now, I don't get it how the just the leadership
Yep.
doesn't understand the value of the businesses and the people in coming in the city and making your city the most attractive and most wanted place, which
Yeah.
people I mean, the people with money can leave.
Yeah.
They can say,
Yeah.
enough of this, I'm out.
Yeah.
Those are exactly the people you want.
Yeah.
If you don't do what you need to do to attract and keep their interest, you'll lose them. And
Yeah.
so
Yeah. And just think about, as a parent, if I'm a parent and I'm looking out the window, seeing the stuff I'm seeing with children, like, I can't keep my kids there. I have to leave the city. You're forcing me out because it's unsafe, and I can't be explaining, what to them. They're not at that age. They shouldn't be seeing the stuff that I'm seeing. So, it seems so obvious and so clear. I wonder if there's something more. It doesn't make sense. It's beyond me.
yeah. Well, I'm with you there, and I don't know what the answer is, but I think unfortunately it's one of these things where it won't correct until it gets worse, or enough people leave to where somebody new in charge
Yeah.
changes the direction. But
Yeah. Yeah.
not something they're asking me to solve, but just my 2 cents. The
Yeah.
where
Same
it's
here.
at. So what as far as looking forward here, um, we've talked about interest rates and kind of the gap in the marketplace between the buyers and sellers. Um, with the information that you're taking in, the conversations you're having with brokers, investors, um, all of the different players, what are you, or where are you with expectations as far as whether it be a new normal that people just accept this is the marketplace, or things change for the better to where it feels more easy to do business? Do you have any sense of time that you guys are are looking for, or do you have any sense of that, or is it just you keep looking until you see something that works and maybe you find somebody that has to sell and you're able to pick up a deal?
Yeah, we're very tuned into CPI each month, to the consumer price index, and just monitoring the pace of inflation, just to see how quickly it changes and can they get it under control and what does it look like. You look back at history based off of the last 40, 50, 60 years, them bringing inflation down, it doesn't happen as quick as some people might think. Years it can take. So, heading into this environment, it's hard to say what the heck is coming. It's hard to say, with how quickly they've raised interest rates and how quickly things have come to a stop, at least in real estate. Will it be something we haven't seen before? I'm not putting my money on it. But what we're really doing is we're taking care of what we have. We're making dang sure that the assets we do have, we're asset managing to the absolute best of our ability. We're making sure all of our team members that we do have in place are trained well and are taking care of our tenants, focusing on the fundamentals, making sure that any of our debt that we do have, it is variable. How are you going to exit it? What does it look like? Can we exit it sooner? And just kind of hunkering down, and seeing how far this needs to go for the system to break. I think that's probably the next step. Is at some point you'd think that there will be something that breaks in the system where they have to make a pivot move.
Yeah. No, and it is kind of that. I feel like more and more of the people I talk to, there's plenty of people I talk with that are looking, that are, hungry, that want to do a deal, but it's trying to get the numbers to make sense. And I'm curious, when you go and underwrite a deal, and you mentioned kind of like the whisper price. Um, if you're not able to get there, do you whisper back a price where you'd be interested, or you just, is it kind of like, it doesn't work for us?
Yeah, we always do. I think that's one thing that helps you with your reputation as you go to build relationships with these brokers, is they want to know where you're coming in. If you got a seller who's selling and they take the deal out to the market and all the buyers come back and there's a $2.5 million gap, they can at least go back to the seller and say, you guys are $2.5 million off. What do you want to do? And see if they can get the seller to adjust or if he's just holding steady. So I think the real deals you're going to see come to the market will be because of force of sale, in the sense that their bridge loan variable debt has gone up too much. They don't have a rate cap in place and they can no longer make the debt payment. They either do a capital call to investors or they need to offload the deal at whatever level they can. So if things don't change, that seems like the most logical exit for the deals that are distressed.
I got it. Um, as far as the markets you're invested in Nashville and Dallas, um, are those the two markets that you're limited to? Do you have any sense of anywhere else that you might go if you were to? What would be some of the I don't want to say the where, but what would be some of the criteria, or let me put it this way: historically, there've been certain things that people have looked to. Mainly, I would say population growth and jobs, and demand for housing.
Mm-hmm.
Has any of that changed for you given the COVID experience? And if so, what are some of the characteristics, or the
Yeah.
market characteristics that have changed
Yeah.
since?
Yeah, I would say one of the things that we're more focused on than ever is just your 1 mile median income, of what kind of demographic are you buying in and what kind of laws are being passed by politicians that give your tenants more rights than you. You're the one buying the property, putting the debt on the property, guaranteeing these loans, taking the risk, building the business plan, bringing these investors together, working on the property day after day. And then your tenants have the ability to not pay their rent and they can stay. That just doesn't work. So where are you going to buy so that it doesn't matter what the government does, that the people care enough about their credit or their future to perform, and that just means pay rent. At the end of the day, when I buy a home, I don't just call the bank and say I'm not paying this month and they say no worries, just stay there and enjoy. They just take the house. so it is a little black and white, but that's the way it is.
Yeah. No, I just it is kind of screwy, but I think as an investor you have to be, hyper aware of that kind of stuff, so that you can protect your asset. And
Definitely.
I was having coffee with some investors this morning. We got to talking about it. And it's not so much that you have the one uh, bad apple, if you will. I mean, and honestly, I mean, the other part of this conversation was, evictions on a smaller portfolio are not something you're dealing with all the time. It's kind of a rare kind of thing. But as you get to scale, it's more of a common. I mean, it becomes more of a regular thing. But just how a a tenant that needs to go is likely causing other problems that may bleed over to some of your other good tenants that don't want to be around, that situation. And so it really is, it becomes more of an operational um, thing, and just how you can contain that and get rid of that problem as efficiently as possible, so it doesn't become more of a, larger problem. But
Right. Right.
uh,
Could not agree more. I mean, that is something we're evicting constantly, unfortunately, in this environment. There's more in some demographics than others, but I mean, there's always folks that just decide not to pay. I don't know what happens exactly, or because if they're willing to work with us, or they give us a heads up that things are challenging, then we can work with them. But they just stop communicating and skip, or whatever it may be. They just go silent on you, and I'm not sure what's going on over there.
yeah. No, that's always kind of a pain that, I mean, nobody wants to go there. But something you gotta have the access to it when you need it so you can protect yourself. So
Yep, you
gotcha.
bet.
Hey Dan, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies that we typically consider. We first look to see if there's a way we can avoid the risk. And when that's not an option, then we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, then we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your investors, your tenants, the market, the interest rates, political, however you choose to identify what you consider to be the biggest risk. And for clarification, again, while I'm an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Dan Brisse, what is the biggest risk?
Yeah, I would say that there's a couple, but the one biggest one is get your debt right in this market, particularly. If your debt's wrong, it can blow up the deal, and you can lose the entire deal, lose all investors' equity. So I'd say that right now is the most important piece if you're looking for the one biggest risk.
No, I think that is a pretty good answer given the circumstances. So I gotcha. Hey Dan, where can the listeners go if they'd like to learn more or connect with you?
Yeah, they can just go to our website, www.granitetowersequitygroup.com, and there's a contact us form. Fill it out, little email, phone number, hop on a call, and we can get to know you guys better, see if what we do is a good fit for you.
Awesome. Well, Dan, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Yeah, thanks for having me on, Darren. It's been great.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.